The Federal Reserve just flagged three forces it believes could push prices higher, and they couldn't be more different from one another. Tariffs, a potential war with Iran, and the artificial intelligence buildout. Here's what the Fed actually said, why it matters, and what it means for your financial world. The Federal Reserve has published a report warning that inflation risks have stepped up, and it points to three distinct drivers. First, the ongoing wave of tariffs. Second, the threat of conflict involving Iran. And third, the massive build-out of artificial intelligence infrastructure across the economy. The Fed's language here is deliberate. Stepped up is not the same as out of control, but it is a clear signal that policymakers see the path back to their 2% inflation target as more complicated than it looked even a few months ago. This is the Fed doing what it does periodically, laying out the landscape of risks it's watching, so that markets, businesses, and the public understand what's on the table. So why would tariffs, a geopolitical conflict, and an AI spending wave all end up in the same inflation warning? On the surface, they look like completely unrelated stories, but through the lens of inflation, they share a common thread. They all have the potential to raise costs across the economy, and when costs rise broadly, prices tend to follow. Let's take each one in turn. Tariffs are essentially taxes on imported goods. When a government imposes a tariff, the company importing that good faces a higher bill. That higher bill often gets passed along to manufacturers who use those inputs and eventually to consumers who buy the finished product. The debate economists have is always about how much gets passed through and how quickly. But the direction of travel is rarely in doubt. Tariffs add cost pressure to the system. The Iran dimension is different in nature. It's a geopolitical risk, specifically the kind that can affect energy markets. Iran is a significant oil producer, and any escalation of conflict in the region has historically introduced uncertainty into global oil supply. Energy prices feed into almost everything. Fuel costs affect transportation, which affects the price of virtually every physical good. Heating and electricity costs affect households directly. So when the Fed flags an Iran conflict as an inflation risk, it's really flagging the downstream effects of potential energy disruption. And then there's AI. This one might feel counterintuitive. Isn't technology supposed to make things cheaper and more efficient? Over time, perhaps, but right now, building out AI infrastructure requires enormous quantities of physical resources. Data centers consume vast amounts of electricity. They require specialized chips, cooling systems, land, construction labor. That demand doesn't appear out of thin air. It competes for resources across the economy, and competition for scarce resources tends to push prices up. Now let's get into the mechanics of how these three forces actually translate into inflation, because understanding the transmission is where the insight lives. With tariffs, the mechanism runs through supply chains. Businesses that rely on imported inputs, whether that's steel, electronics components, or consumer goods, suddenly face higher costs. They have a choice: absorb the hit and compress their margins, or raise prices. In a competitive market, many will absorb some and pass on some. But when tariffs are broad, when they affect multiple categories of goods simultaneously, there's nowhere to hide. Widespread cost pressure at the input level tends to show up as broader price increases at the consumer level, and that feeds into the inflation measures the Fed watches. The Iran risk works through what economists call a supply shock. A supply shock is when the availability of a key input, in this case energy, is suddenly disrupted or threatened. Oil markets are globally integrated, which means a disruption anywhere can affect prices everywhere. And here's the key thing about oil. It's not just a fuel. It's an input into plastics, fertilizers, chemicals, and logistics. So an oil price shock doesn't just hit the gas pump. It ripples through the cost structure of the broader economy. Disruptions of this kind tend to lift war risk premiums in shipping and insurance, which adds yet another layer of cost. The AI build-out mechanism is more subtle, but increasingly hard to ignore. The scale of investment being directed into AI infrastructure is extraordinary by historical standards. That investment is concentrated in a relatively small number of physical inputs: high-end semiconductors, electrical grid capacity, data center construction. When demand for something rises sharply and supply can't keep pace, prices rise. The electricity demand alone from large data centers is significant enough that in some regions it's already prompting conversations about grid capacity. When a new and powerful source of demand enters an economy, it doesn't arrive silently. It competes, and that competition has a price. So what does this mean in practice? The Federal Reserve's core job, mandated by law, is to maintain price stability and maximize employment. When it sees inflation risks stepping up, it has to factor that into its thinking about interest rates. Higher rates are the Fed's primary tool for cooling inflation. They make borrowing more expensive, which slows spending and investment, which reduces demand, which takes pressure off prices. The implication here is that the Fed's ability to cut rates, which markets and businesses have been anticipating, becomes more constrained when inflation risks are rising. If the three forces the Fed flagged were to materialize simultaneously, the resulting price pressure could keep inflation above target for longer, limiting the Fed's room to maneuver. That matters enormously for anyone with a mortgage, a business loan, a bond portfolio, or a view on where stock valuations should be. For businesses, a stepped-up inflation environment means planning becomes harder. Input costs are less predictable. Pricing decisions carry more risk. Companies that can pass costs through to consumers are better positioned. Those that can't face margin compression. For households, it means the cost of living remains a live concern, not necessarily accelerating sharply, but not retreating as quickly as many had hoped. For the broader economy, the Fed's language matters because it shapes expectations. Inflation expectations are self-reinforcing. If people expect prices to rise, they tend to demand higher wages and accept higher prices, which itself contributes to inflation. When the Fed flags risks publicly, it's not just describing the world. It's also trying to anchor expectations by demonstrating that it's watching closely and stands ready to respond. So how do we classify what's happening here? This is a risk identification event, not a policy action. The Fed has not raised rates, has not changed its guidance, has not signaled an imminent move. What it has done is publish a formal assessment that says the inflation landscape has become more complex, and named three specific forces it believes are responsible for that added complexity: tariffs, the Iran situation, and the AI infrastructure build-out. In the taxonomy of central bank communication, this kind of report sits in a significant category. It tells you where the Fed's attention is focused. It tells you what assumptions might shift its calculations. And it tells you that the path to lower rates is not as clear or as short as the most optimistic scenarios assumed. For investors and observers of financial markets, the takeaway is this: the Fed is not in panic mode, but it is in heightened alert mode. Three genuinely distinct forces: trade policy, geopolitical risk, and a technology investment cycle are converging in a way that complicates the inflation picture. That's unusual. Most inflation cycles have one or two dominant drivers. three simultaneous and structurally different pressures make forecasting harder and policy responses more nuanced. The Federal Reserve flagging all three in a single report is the institution doing its job, laying out the terrain so that the decisions it makes next can be understood in context. Whether those risks materialize fully, partially, or not at all remains to be seen. But the Fed has made clear it's not looking away. If you found this breakdown useful, subscribe to Investors Club Global for clear, honest analysis of the financial news that actually moves the world. Hit the like button if this added something to your understanding, and drop a comment below telling us which of these three inflation drivers you think is the most significant. We read every one.